Welcome once again to your financial accounting class revisions. I wanted us to see if we can complete the first mock review. Before I ask the question, Keswick Company acquired 80% of the shares of Derwent Company 1st June X5. Summarized draft statement of profit or loss for Keswick Company and Derwent Company for that year ended 31st May 2026 given below. So our job here is to consolidate these figures, and of course in group accounts the two companies are treated as one. Now we're told below there that during the year there was some trade that took place between Keswick and Derwent. It looks like K sold 1 million thousand worth of goods, 1 million worth of goods to D for 15, making a profit of 500. We are told that 30% of these goods remain in inventory. So we need to prepare the Keswick Group statement of profit or loss for the year ended 31st May 2026. Okay, so of course group accounts should not be as difficult as people report it to be at this stage of your studies, because what you're doing is basic group. So I'm going just to write something. Okay, Keswick Group moment here, SPL statement profit or loss for the year ended. Which is that I'll be making reference to this the 1st May X6 Q20 X6. So again, we can always have our column there where we will have our amounts. So again, group accounts is not as difficult as one would think it is. Let me just write the components of what I expect to see there. There's revenue, there's cost of sales, there is a gross profit, and then there is what we call expenses. If I can say operating expenses, okay, operating expenses, and then we've got profit for the year, profit from operations, yeah. Then we have profit before we have got tax. Let me just check it's actually profit before tax. Profit from operation is profit before tax because there was no finance cost. Profit before tax. And then we have got tax itself. Then we've got profit for the year. Profit for the year. Then now we're gonna have to share that profit between parent and NCI. Okay, so let's begin to do some bit of work here, and I'll be using brackets because sometimes our friends use what we call they might use columns. So let's begin. Under revenue, this is a full consolidation method. Since we have established control of the weight, we are told that parent got 80% of the subsidiary, meaning that they've got control over the subsidiary. Okay, so let's do some bit of work. So 84 plus 32 Okay, 84 plus a 32, then less a 15, the selling price of those goods that we saw. Please let us remember some of these things. You can check the question for the 15. Okay, progress. Then the next one is, if I may check, okay, which one is that? Let's get back there, go back. So we have 46 under cost of sales plus 17, 46 plus 17 minus a 15 plus, now we have unrealized profit, because we're told that 30% of these goods, the goods on which we made profit of 500, remain in inventory. So what is 30% of 500? If I can do that just somewhere by the side, I think I'll be fine. So 30% of 500 is the 150. So we have to add back this 150. That is in accordance with what we're supposed to do in group accounts. So I put that figure 150 there. So let me redo this in the formula. Plus 17 minus 15 plus 150. So notice that the 15 comes out on both counts. Okay, so 4950. If I can write this one in brackets, it'll be okay, because then we'll be able to easily deal with the outcome here. Right, so let's progress to the next one. The next one is the operating expenses, 22 plus 960. I don't think that there was any additional adjustment, but sometimes you might have goodwill as an expense there. Please remember what I've said. Goodwill is to be added to those two expenses if it is given in the exams. So what we have now is that figure. Okay, so again, that 160, but I'm supposed to put it in brackets. So that 160. Okay, next. Let's do this. I'm supposed to put it in the minus. Okay, so let us do some work. I want to find that profit there before tax, and now I need to remove the tax. We have got 600 plus 140. 600 plus 140. And by the way, this is full year acquisition. Okay, we just want to check that. All right, so what we have is our, because I want to put the figure as negative, I think I'll do that. Okay, so what is the profit for the year? Okay, profit for the year will be the sum all these amounts. I've got 1 to 50. So this 1 to 50 must be shared between parent and subsidiary. So what we do first is that we go to the subsidiary and get the profit after tax, or profit for the year, 400, and get NCI share there. So say 400 multiply NCI share is only 20%. So what is 400 by 20%? I'm getting 8 there. Okay, so that parent share of all the resources in the group will be 1250 minus 80 minus 80. So this is a balancing figure. We call this balancing figure. Okay, so that's what you have there, and you have sorted out some of the things that you were supposed to sort out initially. So let us progress now to B. B says, which of the following formulas describes the amount to be entered in the consolidated statements, profit or loss, SPL, attributable to the owners? So group profit after tax minus non-controlling interest. I think that's what we did when we were finding the balancing figure for parent. Group profit after tax plus non-controlling interest is not correct. Case profit for after tax, this is not correct. Group profit after tax is not correct. I think the best option is A. The explanation is, if you want to find that figure, you need to say group profit after tax minus NCI. Please, I want you to remember that. Okay, next question says, what amount should be shown in the consolidated statement of profit or loss for non-controlling interest? I think we have already worked out that one. So we have got 8 there. There's no need for us to reinvent the wheel. Okay, then finally, the following table shows factors to determine when factors to consider rather when determining whether a parent-subsidiary relationship exists. So the question is, you need which of the above factors, A to H, illustrate the existence of a parent-subsidiary relationship. Let's begin. So significant influence, that one is for an associate. Control, yes, we'll get, I think B is being gotten. Where there's non-controlling interest, I think we can assume that the other party is the controlling interest. All right, greater than 50% of equity shares being held by an investor, yes, we can get that one. Then 100% of the equity shares being held by an investor, this one is automatic. Then greater than 50% of the preference shares, this one is not considered. Then 50% of all shares and all debt being held by an investor. Now we don't know whether these shares are voting shares or non-voting shares, but say all shares, perhaps we can conclude that the voting shares are included as well. Then H says greater than 50% of preference shares and debt being held by an investor. I think this one is not in. We don't count that one. So I'm going to go for the following. B, we get non-controlling interest, of course the pinch of salt, assuming we'll leave this one for now, because if we've got non-controlling interest we don't have control. Okay, then greater than 50% we'll get, 100% we'll get, then greater than 50% preference shares we don't get, 50% of all shares we can get this one, assuming that ordinary shares are also part of those shares. So the rest we reject. I want to thank you for listening to this lecture. I want to ask you to come up with questions on the other side. Otherwise, we end here.